Today is the 12th of September 2022. My name is David Hickson, and today's market update is going to be a quick one. We're only going to take a look at the S&P 500. I have only just returned from holidays in the Aeolian Islands off the coast of Sicily, and I couldn't resist making a quick market update to discuss the potential trough that formed in the markets last week. Before we take a look at those markets, I must ask you to please make sure that you have read and understood these disclaimers. So let's take a look at the S&P 500, and this is the analysis that we have been tracking for a long time. We have the March 2020 trough of at least 54-month magnitude, possibly a greater cycle magnitude, but probably only 54-month magnitude. And as you will know from previous videos that I've made, even the magnitude of that trough can be debated because of the possibility that it was created by fundamental interaction at the outbreak of the pandemic. But according to this analysis, it is a trough of 54-month magnitude. Then we have the 18-month cycle trough, which you can see has been pinned over here at the beginning of October, which means that we are now in our second 18-month cycle following the March 2020 trough, and the next 18-month cycle trough is expected early next year. Then, of course, we will experience a third 18-month cycle to bring us into the next 54-month cycle trough, possibly a 9-year cycle trough at that time as well. And so we've been discussing in these videos the fact that this second 18-month cycle has been turning fairly bearish. Here is the first 40-week cycle that elapsed in this second 18-month cycle, and now we are witnessing the next 40-week cycle, which is expected to play out in an M shape to bring us down into this 18-month cycle trough expected early next year. So let's zoom in and consider in a little more detail the trough that might have formed last week. Here you can see the situation in greater detail. There is the 40-week cycle trough that, according to this analysis, occurred in about the middle of June. You can see we have a slightly questionable position for the 40-day cycle trough. People often ask me, how do you gauge the accuracy of an analysis? And the first step to take in terms of determining the accuracy of an analysis is actually a really simple one. You take a look at the trough markers at the foot of the chart and you ask yourself whether that is indeed a prominent trough in the price movement. The reason why I say this is a questionable 40-day cycle trough is because there was a much more prominent trough over here in the middle of July, and we had a very beautiful M shape that played out into that trough. And so positioning the 40-day cycle trough in this displaced position is a little questionable. But a Hurst cycles analysis often involves the resolution of apparent anomalies like that. And so, according to this analysis, we have our 40-day cycle trough over here in the last week of July. As you can see, the result of that is that we have this nest of lows for the 80-day cycle. The nest of lows is, of course, created by these stacked circles and whiskers for each one of the cycles, from the 80-day cycle all the way down to the 5-day cycle on this end-of-day chart. That nest of lows, as you can see, is leaning over to the left, and the reason for that is because the recent wavelength of the 80-day cycle would have led us to expect an 80-day cycle trough to form over here in about the middle of August, or perhaps the third week of August, and so that 80-day cycle trough is overdue. I've been discussing this 80-day cycle trough in recent updates, and I would encourage you to go back and take a look at those updates so that you understand the discussion around this 80-day cycle trough. Now, last week, as I mentioned, a fairly prominent trough seems to have formed in the market. According to this analysis, that would indeed be the 80-day cycle trough, because here is the nest of lows. The way that a Hurst cycles analysis works is that it gives us the expectation for a turn in the markets, whether it's a trough or a peak. And when markets do turn, of course, our first assumption is that that is the trough that we were expecting that has formed. We then turn to our cycle tools, in particular the VTL and the FLD, to confirm the magnitude of that trough. The only VTL that we have on this chart is a 10-day VTL. The reason why this is the only one has to do with the rules and the construction of the VTL, so I won't go into them here. But when price crossed above the 10-day VTL, that confirmed that the magnitude of this trough was of at least 20 days. Now, the way that this works is that we then say to ourselves, if that was a trough of at least 20 days, we count back to a previous trough that we have some confidence in this case the 40-week cycle trough in the middle of June. We count the number of bars, and there were 82 bars that elapsed. The average length of an 80-day cycle, as a matter of interest, is 68 days. If you don't understand why that is, I would encourage you to download the 10 core concepts document that I will provide a link to in the description below this video. But here's the important point. If the cycle that formed a trough last week was of 20-day magnitude, then how many 20-day cycles would we have witnessed since the trough in the middle of June? The answer is a very simple mathematical one. Over 80 days, we would have probably experienced 4 20-day cycles. When 4 20-day cycles have elapsed, that means that that trough should really be a trough of 80-day magnitude. I hope that makes sense. It's a fairly simple mathematical puzzle. So the VTLs provide us with confirmation of a 20-day magnitude trough having formed. Let's take a look at some FLDs. Starting with the 20-day FLD, when price crossed above that 20-day FLD last week, I think it did it between Thursday and Friday's price action, that confirmed that a trough again of 20-day magnitude had formed in the market. No new information there. But you can see that in early trading today, the 40-day FLD has just been touched by price, and if it succeeds in crossing above the FLD at this point, that would confirm that the magnitude of this trough was at least 40 days. And again, we would ask ourselves the same question. How many 40-day cycles would we have seen elapse in 82 days? And of course, the answer would be 2, which would mean that this must be an 80-day cycle trough. This extension of the principle of synchronicity and the principle of harmonicity, two very important principles that Hurst defined, is the way that we are able to confirm the magnitude of cycle troughs even when the magnitude has not been confirmed by price crossing the relevant FLD or VTL. We can use a simple deduction process whereby we can ask ourselves how many of those cycles must have elapsed, and therefore through the principle of synchronicity and harmonicity, the trough that has formed must be an 80-day cycle trough. But now, what about the 80-day cycle FLD, which I spoke about in the previous video that I made about the S&P 500? There is the 80-day cycle FLD, and just to remind you about that discussion, you will know that following a trough of 40-week magnitude, a cycle that is 2 degrees longer than the 80-day cycle that the FLD is based upon, we would expect price to cross above the FLD in an A category interaction. And then at about the time that the 80-day cycle trough forms in the market, we would expect price to find support at the level of the 80-day FLD. Now you can see that price did not really find support at the level of the 80-day FLD on a daily chart. Here is the interesting thing. If we change the resolution of this chart to a weekly chart, which is probably the better way of viewing price interaction with the 80-day FLD, when you're looking at a long FLD, you should look at a suitably adjusted chart in terms of its time frame. It would be foolish, for instance, to be looking at price interaction with an 18-month cycle on a daily chart, although you could, and sometimes you will be amazed by the accuracy of the interaction with the FLD. But if we change this to a weekly chart, as you can see over here, then in fact price has effectively not really crossed down strongly below the 80-day FLD on the weekly chart. Remember that we would be looking at the median price of these bars, and so the median price of that bar would be above the 80-day FLD. The median price of last week's bar is probably below that FLD, but you can see that price has approximately found support at the level of the 80-day FLD on the weekly chart. And so my confidence in the fact that this is an 80-day cycle trough that has formed in this analysis, and we're going to take a look at the other analysis possibility in a moment, is fairly high. Let's go back and look at the daily chart and consider what is expected to happen next according to this analysis. And I have zoomed out a little bit. Let's display our composite model line, which of course takes the information from the analysis on the chart, recombines that and displays an indication in the past of what would have happened in price if the only thing moving the market were the cycles that have been found in the analysis. It then extends that information into the future by simply assuming that the cycles will continue to beat with the same wavelengths and the same amplitude, or at least with wavelengths and amplitude that return to their recent averages, which is an assumption that is not necessarily true, but it does give us an indication of the implications of the analysis, and it's a very useful tool for understanding the analysis that we see on the chart. You can see that the composite model line has, of course, turned up here over last week's price action. We received an interesting question last week about why it was that although the analysis has not yet confirmed the 80-day cycle trough, the composite model line has turned up. Why is that? That is the power of the composite model line. It assumes that the cycles will continue beating with the same rhythm, and it combines that information and projects it into the future. So the composite model line doesn't wait for the confirmation of the trough in the price action. It simply assumes that the cycles are going to keep going, and that's one of the sort of powerful aspects of that tool, if you like. It will often indicate a turn expected in the markets before the trough has been confirmed by the software. We're often asked also why it is that the software has not yet confirmed this trough. There are various complicated reasons for it. One of those reasons, of course, is the fact that the FLD and VTL tools have only confirmed troughs up to 20-day magnitude and possibly 40-day magnitude, and so for those reasons it hasn't actually confirmed the position of that trough. Another reason is because Sentient Trader likes to see the formation of a short cycle trough, so it'll be watching for the first 5-day cycle trough, which should be occurring fairly soon, and it will look for that trough occurring at a higher price, at which point it will then confirm that 80-day cycle trough. But you shouldn't let the fact that the software has not confirmed the trough to affect your trading decisions. I often say that diamonds are not a trader's best friend. These circles and whiskers, or nests of lows, are much more important than the diamonds. We never wait for the diamonds to be displayed on the chart before making trading decisions. Our trading decisions are made in advance when we have a nest of lows or a nest of highs if we're looking at a peak analysis. And so we don't wait for the diamonds to be placed. When the software does place the diamonds, we will already be moving on to our next trading decision. So the implications of this analysis are that the 80-day cycle trough has now formed. Next important troughs are going to be the 20-week cycle trough, expected towards the end of October. Then you will notice that the bearish mood of this market, according to this analysis, is expected to continue. The reason for that, as I mentioned earlier in today's video, is because we are expecting price to come down into this 18-month cycle trough expected in the first few months of next year. But let's take a look at the other analysis that we've been considering recently, which suggests that the trough in the middle of June might in fact be an 18-month cycle trough. I've been showing this chart recently. It is in fact a chart of the ES futures price, which of course has the same underlying symbol, so it's effectively the S&P 500. And you will notice that this analysis has some fairly short 9-year cycles here at the foot of the chart. And let me display the semicircles, which are a fairly good way of understanding the bigger picture, if you like. And the reason why we have those 9-year cycle troughs in those positions is because this is called an ICM analysis. It works on the basis of an initial cyclic model that is built by Sentient Trader on the basis of the results of the spectral analysis that it performs at the beginning of the analysis process. That is something that Hurst himself suggested doing, and he coined the term the initial cyclic model, or ICM. This is a really interesting analysis because it has the March 2020 trough as a 54-month cycle trough, and we'll zoom in a moment, but let me point out the bigger picture, if you like, which is that we are expecting our next 9-year cycle trough later next year, perhaps in about the middle of next year. So in terms of the bigger picture, this is also a fairly bearish analysis, because whereas the other analysis suggested that an 18-month cycle trough is expected early next year, this analysis suggests that a 9-year cycle trough is expected in about the middle of next year. Let's zoom in and consider the price action since the March 2020 trough. The big difference here is that we have already witnessed 2 18-month cycles, which means that we are currently in the third 18-month cycle, which will of course bring price down into this big nest of lows in about the middle of next year. Zooming in even further, you can see that the 18-month cycle trough has been positioned over here in the middle of June. Now, an interesting thing has happened to this analysis. If we measure the number of bars that have elapsed to this trough that occurred last week, you can see there were 82 or 83 bars that elapsed following the trough in the middle of June. Now, the average length of the 80-day cycle on the basis of the initial cyclic model is only 60 days. And so 82 days is a slightly awkward length. It would be a slightly long cycle, as we've already discussed, using the default nominal model. But using this initial cyclic model, it's a slightly awkward length. Looking at the nest of lows at the foot of the chart, you can see that we have a 20-week cycle trough looming ahead, as discussed in previous videos about the S&P 500, but that trough is only really expected towards the end of September. Notice, however, that the whisker for the 20-week cycle does extend all the way back to about the 3rd week of August. And so it is possible that this trough that formed here was the 20-week cycle trough that was expected according to this analysis. But that's not really a very good and clean analysis picture. Some other things to notice about this analysis are that we have a 40-day cycle trough below this fairly obvious trough that I pointed out earlier in today's video. We also then have a straddled 80-day cycle trough. A straddled trough is simply a trough that appears very insignificant according to the magnitude of the trough. The reason that straddled troughs occur is because of the effectiveness or the strength of the longer cycles. In this case, it would probably be a 20-week cycle. So in other words, the 20-week cycle was pushing up strongly, which meant that when the 80-day cycle trough was trying to form a trough, it was pretty much overshadowed by the longer cycles, the 20-week cycle, perhaps even the 40-week cycle. The 20-week cycle has probably caused price to come down again. But here is yet another anomaly in this analysis, because here we have a 40-day cycle trough, which is what I mentioned in the previous market update video about the S&P 500 we would expect to form if this analysis turned out to be the correct one. However, the recent bounce out of that trough, the bounce that occurred last week, is a bit too strong for this to be the bounce out of the final 40-day cycle in a 20-week cycle. And so we have several anomalies in this analysis. You'll often find when you're tracking different analyses on the basis of Hurst cycles that one analysis will look really good one week, but then price action just doesn't quite work. What is most probably happening here is that the 20-week cycle has come in early, if this is indeed the correct analysis. Either way, it seems very likely that the 80-day cycle, or perhaps the 20-week cycle, if this is the correct analysis, formed last week. Let's quickly take a look at the implications of this analysis. If we display the composite model line, you can see that the composite model line still has the displaced 20-week cycle trough over here. And so the composite model line was certainly not expecting this big bounce. In fact, you can see the small, rather insignificant bounce that it was expecting out of the 40-day cycle trough. When you have price moving fairly separately from the composite model line, it's certainly a moment to call into question the analysis. And in this particular situation, it raises the chances, in my opinion, that this 20-week cycle trough has formed, which is not entirely unexpected because here is the circle and whiskers, or at least the whisker for the 20-week cycle, indicating that this is within the range of reasonable time that 20-week cycle trough could have formed. It will be interesting to see how things play out if the analysis does position the 20-week cycle trough over there. You can see here is our very neat nest of lows for bringing price into the 40-week cycle trough, which is expected early next year. I think you'll see that even though we're looking at two different analyses here, the expectation between the two of them is really very similar. We are certainly going to enjoy a bounce up now. We might be looking at a 20-week cycle trough in the other analysis, as I pointed out earlier, but then after price bounces out of that trough, the move down into early next year is likely to be a fairly strong one. I do hope that you found this market update useful and interesting. Remember, if you have any questions, please join us on our Discord server. We have many people there who are very experienced in Hurst cycles. I know many of them personally, and they are sharing their knowledge and their experience very generously. So please join us there. And of course, you are very welcome to ask your questions in the comments below this video.